if you're married and you're nearing retirement, then deciding when to claim Social Security isn't just about you, right? It's about you and your spouse. I mean, it's really a strategy for your entire household. And so, what should you do, right? I mean, should you both claim early? Should one of you maybe claim benefits early, but the other one maybe delay, or maybe should both of you delay? And if you do delay, until what age? It's a big decision. And I've seen couples make what at the time felt like a safe decision only end up costing themselves potentially now tens of thousands of dollars over the long term. I once worked with a couple. They claimed early because they said that they were nervous about the system running out of money. And about 10 years later, one spouse had passed away and the survivor was left with a significantly smaller monthly check than they had expected. Now, they didn't do anything wrong per se. They just didn't realize how permanent that their choice really was. And so in this video, I'm going to walk you through kind of the exact framework and things to be thinking about when deciding when to take Social Security and how to integrate it within your overall retirement plan. And of course, we'll also talk about some of the more common timing mistakes. So let's get into this here. So, first of all, I want to make mention that if you are single, the decision isn't always simple either. I mean, you still need to figure out when to withdraw from savings versus when to start your Social Security in order to optimize your after-tax retirement income. But for married couples, it's even more nuanced because you're not just deciding for yourself, you're also deciding, okay, how much, do we want having coming into the household in total now? Because, the big picture is you probably have other income sources, right? You have Social Security, maybe a pension, maybe a 401k or other savings and investments. So, questions come up as to when you're going to start drawing on those and just gets involved. Another thing to consider, of course, is how much the surviving spouse is going to get later in that survivor benefit. And of course, considering how to manage taxes, longevity risks, all of these things. The right timing for both spouses can vary widely depending upon your overall financial picture, your health, and your overall goals. And so what I want to do here first, before we really kind of dive into some of the other stuff, is I want to make sure that you understand how spousal and survivor benefits work and how they're different. So with spousal benefits, these can allow one spouse to receive up to 50% of the other spouse's full retirement benefit, not their delayed amount. Another thing is you must be married for at least one continuous year, and your spouse must have filed for their own benefit for you to receive a spousal benefit. Also, you'll only receive the higher of your own benefit or the spousal benefit, not both. If your own benefit is higher, you're not going to receive anything extra, I should say, as a spouse. But if your own is lower, then Social Security will top you up to give you this, the extra spousal amount once your spouse claims. So a very simple example, let's say your Social Security benefit is at full retirement age, but let's say it's $3,000 and then your spouse's is $2,000. Well, the most that the spouse could get would be half. So half would be $1,500 in that case. But because their benefit is $2,000, they're going to get the $2,000. Now, if that other spouse's benefit was $1,000, then there would be a spousal top up. They could help get that up to the $1,500, up to half. Now, a common misconception here is that if one spouse delays benefits until age 70, very often I find people assume that the other is going to get 50% of that larger amount. This comes up all the time. I hear, I filed at 70 and, my spouse, I'm looking at it doesn't look like they're getting half. It looks like they're getting some number less. And that is correct. I mean, because what's happening is that spousal benefits are based on 50% of the spouse's full retirement age amount, not the delayed benefit. So it doesn't mean that you shouldn't delay even till 70, but just know that that's how it works with the spousal benefit. Now with survivor benefits, you can begin these as early as age 60 or even age 50 if you're disabled. You can claim a survivor benefit first, and then you can later switch to your own or vice versa. So this could come in handy. I know I'm talking about, maximizing benefits for married couples, but if one spouse were to pass away, especially early, maybe even a little bit before retirement, is to know that, hey, there might be this survivor benefit, and then I have my own benefit, and there's ways to coordinate that. So I'm not going to get into the details there, but other than just to say that you can start with one and then switch to the other later on. So and you want to take a look at that if that's your situation, to see how you can, utilize that to potentially maximize your lifetime benefits. Another thing here is that the survivor benefit is based on what the deceased spouse was receiving or what they were eligible to receive at time of death. So if you're delaying taking your benefit until a later time, but you haven't actually turned it on, maybe you're now 68, 69 years old, you're planning, maybe to delay it till 70 was the plan. Well, if you passed away, let's say at 68, and that benefit would have been higher, then the surviving spouse will receive that amount that you would have received if you had claimed benefits at that time. Let's talk about the problem with both spouses claiming early. This is interesting. It might seem like a smart move at the time. I mean, you both turn 62. Let's say you're both the same age. You both turn 62, and then you decide, hey, we're just going to go ahead and claim our benefits right away. And by doing this, you get that instant income. You feel more flexibility, you got more cash flow coming in, feeling less stress, right? But here's what you're giving up by doing that. You're locking in, number one, a permanent reduction. It's up to 30% lower for life. So if you claim at 62 and your full retirement age benefit is 67, that's a 30% reduction. Also, you reduce the survivor benefit, potentially leaving your spouse with significantly less income in the future. And this can really affect you, especially if one spouse were to pass away really early in retirement. Also, you miss out on delayed retirement credits, which increase by 8% actually between full retirement age and age 70. So not saying that everyone should wait until 70, but just to know how that kind of works. That really your benefits will increase each month that you delay, but they really increase significantly, especially after full retirement age. Now, let's talk a little bit about the earnings test, because this is important too, especially if you're considering filing early. So if you claim benefits before your full retirement age and you continue to work, your benefits might be reduced temporarily. So in 2025, Social Security deducts $1 for every $2 that you earned above $23,400. And in the year that you reach full retirement age, it's not as bad. It's $1 for every $3 above $62,160. Now, your benefit isn't affected by your spouse's income if you're claiming on your own work record. But if you're receiving a spousal benefit and your spouse is still working, your benefit could be reduced. So you need to be aware of that. Another thing here too is that if you feel like, maybe you made the wrong choice, and you change your mind, well, if you claimed early and now you're regretting, you have a couple of options. Number one, you could withdraw your application if it's within 12 months and then repay what you had received. Or you could suspend your benefits at full retirement age and then earn delayed credits going forward. So that's a couple of options that you have. Now, one strategy that can work for couples, I'm not saying this is necessarily the best strategy. It's always a case-by-case basis, but it's one thing to consider, is the split strategy as it's referred to. And the way that it works is that the lower earning spouse claims early, which provides some income in the early years of retirement, and then the higher earning spouse delays their benefits for longer, maybe till full retirement age, perhaps even until age 70. And the reason that this can work well is that the smaller benefit provides short-term income and flexibility with getting that cash flow. And then the higher benefit, that one continues to grow each year due to the delayed retirement credits. And then that can then strengthen your long-term income and, of course, boost the future survivor benefit, for that surviving spouse. Meet Jan and Mark here, I'm going to call them. So Jan was in and out of the workforce. She stayed home a lot with the kids. And then Mark had worked in an office job for decades. So really his whole working career. And when they came to me, they were both 62. They were both ready to retire. but they were unsure of whether they should take Social Security now or should they wait, or really what was the best choice. And so we ran the numbers and decided that Jan would claim early, giving them some breathing room, while Mark went ahead and delayed until 70. So that's the split strategy here. And that decision not only gave them that flexibility, like I'm talking about, it now provides Jan, who's a widow, with a strong survivor benefit that helps her maintain the life that they built together, helps give her more of that income now, that she needs with one Social Security check going away. She often tells me, I'm so glad that Mark waited, because by doing that really made all the difference in my monthly income. And this strategy, it can often help to maximize lifetime household income. So it can be good. It can also help to reduce drawdowns from investment accounts early on, because if you have some cash flow coming in from that lower earning spouse, that means less money needs to be withdrawn from your investment accounts. So that can help. Another example, I work with Luis and Michelle, and they had substantial savings, and they wanted to optimize their long-term tax strategy. And so we chose to delay both of their Social Security benefits while drawing strategically from their IRA. And so this is a little bit of a different situation. And so with this, again, we decided to delay both. They were in their early 60s, and we were going to delay until at least full retirement age, so age 67, but maybe even delaying one of their benefits even longer, the higher benefit even longer, perhaps till 70. Again, because what we wanted to do is to start drawing down strategically from their IRA, and also to incorporate some Roth conversions before turning on those Social Security benefits. And, by doing this, it opened up at least a 5-year window in their case, from 62 up until, full retirement age of 67, to, again, do all these different things, to start withdrawing from an IRA, or to do Roth conversions and things like that. And the reason that we did that, their RMDs, when they have to go ahead and take those are going to be lower, because they've already taken some money out of their IRA. And so, now we've made it so that when they do take RMDs, it's not going to be this huge amount that they have to take out. That's actually going to be, that would have been more than they would have actually needed in order to meet their living expenses. That's why I point out these are kind of two different situations. Everyone's situation is going to be different, but now for them, because their future RMDs are going to be less, that means that most likely now they'll not have to pay as much for Medicare due to the IRMA surcharge, which I won't get into details with here. But other than to say that if your income's higher, you'll pay more for Medicare due to IRMA. A lot to think about, and different strategies can work differently, or better or worse for different people. So you definitely want to run the numbers. I mean, that's why we do this when building plans. And so, before you decide when to claim, it's important to step back and look at the bigger picture of your overall retirement plan, and ask yourself, what other income sources do we have? Social Security, pension, right? 401k withdrawals, whatever it is, rental property. When we decide on this Social Security, thinking through, okay, what is our break-even age, or at least potentially, what's that going to be when doing this? And it's important to look at this within the context of your overall plan. And I say that because, there is different Social Security software that's out there, and I've used it. One of the things to make sure that we need to be careful of is that, of course, taxation and all. And also, if you take Social Security early, we would need to factor in, okay, what rate of return are we assuming that we might be able to earn on this money if we take it early, but maybe we don't need those benefits. Some of those calculators aren't taking all those different things into account. So the decision needs to be plugged into looking at the numbers for the overall plan. Now, I'm not saying that you should both delay, or even that it's really the best choice. It's only just to point out that some of the things that could be considered, again, are the buy delaying that might open up that window to do Roth conversions, then potentially at a lower tax rate. Could also put you in a position maybe to realize capital gains strategically by doing the conversions, or just withdrawing money from IRAs. That could potentially lower your future RMDs and potential IRMA surcharges, the additional costs for Medicare. Also with Social Security, remember, up to 85% of that could be taxable, but it's only other income that can make that taxable. So again, it's thinking strategically about when you're going to take that, when you're going to withdraw from different accounts, and then how to, potentially reduce the amount of your Social Security benefits that would be subject to tax. Now, I've had clients that were worried, about delaying, afraid of, they were going to miss out, or really wasn't a good decision. But, for some, it really was. It gave them that peace of mind later on, knowing that, they had done some planning up front from a tax standpoint and now had these higher Social Security checks. Again, doesn't make sense for everybody. Sometimes I will tell people you should absolutely both take benefits early, right away. Other times, both delay. Other times, some sort of split strategy. It all depends on health, longevity. It depends upon your overall retirement income plan, your tax situation, and all of that. And if you get the timing wrong, it could end up costing you tens of thousands of dollars, either in lost benefits or perhaps in higher taxes. And I don't want you to look back, 10 or 20 years from now, perhaps, and then, think, I really wish I would have known what my options really were. I've seen both sides. I've seen couples that rushed, they made decisions, and I've seen couples that really planned it out carefully. And the difference in peace of mind and lifestyle, long-term security is real. So if you want help building a plan that's tailored to your situation, I've added a link below where you can learn more and schedule a free strategy call as well. I want to thank you for watching, and I'll see you next time.